My name's Ned Bell. I'm the Chief Investment Officer of Bell Asset Management, and this is our market outlook for Q1 2022. So when we look at the world has changed somewhat. I think it's probably fair to say in the first quarter of this year, some of what's transpired was very much in line with what we've been expecting. So if we dial the clock back to late last year, our view was that we're moving into an environment whereby inflation was becoming more problematic, emerging markets were going to continue to suffer, and the global macro picture was going to continue to soften somewhat. So all those things have happened. Clearly, I don't think anyone anticipated what's subsequently happened in Europe, but that has obviously exacerbated a lot of the risks surrounding growth and inflation. And when we think about the performance of some of the sub-asset classes, we've obviously seen a huge rotation out of growth into value. So that's not something that's totally surprised us. What we've seen is a pretty monumental shift in terms of growth, particularly. So when we think about the very large growth stocks that are very well known to us, and we think about the likes of Netflix, Meta, Alibaba, Tencent, Nvidia, those names are down on average 39% year to date. So you're seeing huge drawdowns in some very big, well-known names. And there's really two factors that are instigating these drawdowns. The first one being that the magnitude of earnings growth is flattening quite substantially, which was always going to happen, but probably the macro environment has brought that on a little bit more. And you've seen multiples compress, which is exactly what you would expect when interest rates tick higher. So you're seeing a very big sort of change in terms of where the momentum is in terms of the various style buckets within markets. Interestingly, quality stocks as a whole have lagged. They've lagged by a bit over 3% in the first quarter of this year. And the way we think about that is somewhat of an anomaly. So they've done a little bit better than growth, but obviously worse than value. But when we think about the performance of quality as a style, this is literally the perfect environment for quality investing. And the reason for that is that basically, if you think about quality companies, what determines a quality company? There are two key features. The first one being is that they are consistently very profitable, and therefore they have pricing power. Now, companies have not necessarily been rewarded for their pricing power in the last 3 years. They've been rewarded for their growth metrics. The second point is that when you think about quality, it's looking for companies that don't have much leverage in their balance sheets. They don't have a lot of debt. So companies with pricing power and a lack of interest rate leverage are perfectly positioned for this environment. And again, if we think about the environment, we're going into an environment whereby you've got inflation is at a 40-year high. It ticked over 8% recently. It'll come off 8%, obviously, but it is very broad. It's coming from energy, food, employment, from housing, from transportation. So it is very widespread. COVID hasn't gone away, unfortunately. And clearly the Fed has been caught well behind the curve, and we will have some interest rate hikes to come. So the environment is very, very conducive to quality investing. And I think, and that's much more the case than probably has been in recent years, where it's been growth at any price has been the strategy that's worked. And when we think about, if we go back over history, you look at quality, what the types of environments when quality is done well. If you look at the US economy, and in calendar years when US CPI has been north of 3%, quality as a factor outperforms by 3.3% per annum. So there's a very reliable history that shows that quality does well in this type of environment. And so if our starting point is negative 3.5%, history tells us positive 3.3% in those years. There is a strong argument that the market right now is representing a decent disconnect from a pure style perspective. So I think that's really important when investors are thinking about style. More generally speaking, clearly we are going to an environment whereby growth is slowing pretty meaningfully from a macro perspective. And I think, and backing up from that, I think really importantly, the composition of growth is changing also. So the last 10 years, it's no secret that emerging markets as a whole, led by China, has been a big part of the global growth picture. For the first time in probably 20 years, you're seeing the GDP growth forecast for emerging markets as a whole are not that much higher than developed markets. So that is a first. And I think that will have investors really starting to rethink the emerging markets asset class as a whole, because if you're investing in emerging markets and you're not capturing that GDP growth premium, you frankly need to ask yourself why you're there to begin with. So I think that there's a lot of things starting to happen for the first time. Clearly, the geopolitical environment has taken a pretty meaningful turn for the worse, which has created a lot more uncertainty. So there's a lot of, there's obviously a lot of negativity and risk creeping its way into markets. Having said that, I think from a bottom-up stock picking perspective, these sorts of environments are always the environments when you get the opportunities to buy the best companies at dislocated prices. And so if we're to look at investing on the basis of taking a 3 to 5 year view and being opportunistic, and again, we had this same opportunity going in Q1 2020 when markets didn't know how to cope with COVID, they didn't know how to price it in. We're seeing almost Act 2 happen now, albeit somewhat different. That's starting to throw up great opportunities. So this is a great time, we think, for active management. I think the risks to do with overall passive management have absolutely come to the fore in Q1 of this year, and that just buying momentum and buying factors and buying the market as a whole has definitely got some flaws. So being nimble and agile in markets at the moment is really, really important. So notwithstanding the somewhat negative backdrop from a bottom-up stock picking perspective, we're very optimistic. We feel like we're incredibly well positioned. We're finding great opportunities falling into our lap, and we feel very confident that we're moving into a period where we can generate fantastic alpha for all of our strategies.